Welcome back to the MbaguMedia Finance Podcast. Today, we're diving deep into a significant shift in the global economic landscape, China's pivot to a mid-single-digit growth economy.
That's right. Beijing's recent GDP growth target of 4.5% to 5% isn't just a number, it's a clear signal that China is recalibrating its economic engine. For so long, we've been accustomed to hearing about their relentless double-digit expansion.
Exactly. This more modest target is a tacit acknowledgement that the high-octane model which powered their rise for over 40 years is facing significant strains. It's not about failure, but a strategic pivot towards stability and sustainable development.
Absolutely. This shift from explosive expansion to a more deliberate, managed phase is a fundamental change. It signals a move away from the growth at all costs mentality that defined their economic miracle.
Let's start by looking at the legacy of that high-octane growth. For decades, China's rise was fueled by a potent mix of export-led manufacturing and massive infrastructure investment. Think about the sheer scale of factories and projects built.
It was truly unprecedented. This created a virtuous cycle. Manufacturing jobs drew millions to cities, incomes rose, consumer spending increased, and domestic production surged. This period, the China miracle, saw consistent growth above 8 to 10% annually.
And this consistent, rapid expansion became almost a dependency. The entire economic apparatus was geared towards maintaining that momentum. It created a belief that this model was somehow immutable, destined to continue forever.
But even strong foundations show wear. The very factors that propelled growth are now presenting challenges. We're seeing demographic shifts like an aging population and declining birth rates, which means a shrinking labor force and pressure on social welfare.
That's a crucial point. Rising debt levels, especially at the local government level, are a persistent concern, limiting their fiscal maneuverability. And globally, the landscape has shifted dramatically with increased protectionism and trade tensions.
And let's not forget the diminishing returns on capital investment. Pouring more money into building more factories or roads just doesn't yield the same explosive growth anymore. It's like pushing a pedal that's already near its limit.
Exactly. The global environment is also less accommodating. The world isn't a unified marketplace eager to absorb everything China produces. It's more fragmented and competitive. So, this section really sets the stage. The old engine is sputtering.
And that brings us to the pillars of economic friction. We need to understand the specific issues forcing this recalibration. The most prominent is undoubtedly the ongoing property sector woes.
For years, real estate was a colossal growth engine, driving investment and related industries. But over-leveraging, regulatory crackdowns, and a cooling market have led to defaults and a general malaise. It's a significant drag.
Closely linked is the issue of local government debt. In their pursuit of growth, these governments took on massive debt, often through off-balance sheet vehicles. This leaves them in precarious financial situations and restricts their flexibility.
Then we have those demographic headwinds we touched on: the aging population and declining birth rate. This shrinks the labor pool and increases the burden on social welfare systems like pensions and healthcare. The long-term consequences are stark.
And compounding this is the persistent lag in consumer confidence. Despite policy efforts, households remain cautious due to job security worries, the property market, or future social costs. This reluctance to spend directly impacts domestic consumption.
Adding another layer is the geopolitical and trade uncertainty. Global trade disputes and technology transfer restrictions create a highly unpredictable environment for Chinese businesses, dampening investment and complicating planning.
And finally, the difficulties in implementing structural reforms. Beijing talks about transitioning to a consumption and innovation-driven economy, but this faces resistance from entrenched interests and the sheer inertia of the existing system.
So, it's this intricate matrix: property woes, debt, demographics, consumer caution, geopolitical friction, and reform resistance that makes sustained high growth increasingly difficult. The 4.5% to 5% target acknowledges these deep-seated issues.
Which leads us perfectly into the balancing act: stability over speed. This new growth target reflects Beijing's delicate policy tightrope walk.
They're trying to maintain economic stability without reigniting inflation or exacerbating debt. This suggests a deliberate shift from the quantity of growth to its quality and sustainability.
This involves fostering innovation and nurturing high-tech sectors as new growth drivers, rather than relying solely on the old engines of manufacturing and infrastructure. It's a gradual steering of a massive supertanker.
There's a constant risk assessment: stimulate too little and risk a sharper slowdown, or stimulate too much and create new imbalances. The 4.5% to 5% range signals a cautious, deliberate approach, perhaps more akin to developed economies.
The real challenge then becomes managing expectations, both domestically and internationally. Can the policy tools at Beijing's disposal navigate this transition without significant disruption? That's the million-dollar question.
And this brings us to the global ripples, reshaping the world economy. China's moderated growth ambitions have profound implications far beyond its borders.
A slower-growing China means altered demand for global commodities and manufactured goods. Remember its insatiable appetite over the past few decades? That will likely wane, presenting challenges and opportunities for other economies.
For nations reliant on exporting to China, this could mean reduced markets. But it might also accelerate the trend of rebalancing global supply chains, with companies diversifying production bases to other regions.
This shift could also accelerate the trend towards regionalized trade blocs. Investment flows might be rerouted as global capital seeks new growth frontiers, potentially increasing investment in other emerging markets.
The overarching narrative of China's unstoppable rise is giving way to a more nuanced understanding. This moderation impacts everything from energy prices to multinational corporation valuations. The world is recalibrating.
Understanding China's internal economic strategy and the factors driving this moderated growth is now more critical than ever for accurate global economic forecasting.
Let's talk about the human element, domestic and global impacts. What does this recalibration mean for the average person?
For Chinese citizens, it suggests a future with less emphasis on relentless wage growth and more on social safety nets, environmental quality, and equitable wealth distribution. The focus shifts from how fast to how well are we growing.
This could lead to more stable employment and a greater appreciation for domestic well-being over sheer economic output. It's a subtle but significant change in societal priorities.
Internationally, multinational corporations must reassess their strategies. Those built on assumptions of China's high growth need to adapt, potentially diversifying manufacturing and focusing more on resilience.
Consider commodity prices. China's demand for raw materials has been a major price determinant. As its industrial expansion slows, this demand may stabilize or decline, presenting challenges for resource-rich nations but perhaps offering price stability.
Furthermore, as China moves up the value chain and develops its tech prowess, it may become less reliant on certain imports and more competitive in high-tech sectors. This could intensify trade frictions.
The global economic order, shaped by China's rapid ascent, is entering a new phase. This 4.5% to 5% target is a signpost towards a more sustainable, less explosive economic future, demanding careful observation and adaptation.
Now, let's move into the summary table. First, under key factors, the GDP growth target itself signals a strategic pivot towards stability and sustainable development. It allows for more focused policy without risking overheating.
However, the challenge is that lower growth may impact global demand for commodities and manufactured goods. Managing domestic expectations, accustomed to higher growth, is also a significant hurdle.
Regarding the property sector, regulatory efforts aim to deleverage it and create stability, potentially freeing up capital. But the ongoing woes continue to drag on economic activity and impact household wealth.
The risk of contagion if the property sector isn't managed carefully is substantial. For local government debt, the increased focus on fiscal prudence is a long-term strength, leading to more sustainable public finances.
Yet, the high existing debt levels severely restrict fiscal maneuverability, limiting the capacity for stimulus. This poses a potential for financial stress if revenue streams falter.
On demographics, shifting towards higher value-added industries and automation can mitigate the impact of a shrinking labor force. Increased domestic consumption can become a more significant growth driver.
The challenge here is the aging population and declining birth rates, which mean a smaller workforce and increased social welfare burdens, posing long-term threats to economic dynamism.
For global and geopolitical factors, supply chain diversification and regional trade could foster new economic partnerships. Focusing on domestic innovation can also reduce reliance on foreign technology.
But increased protectionism, trade tensions, and geopolitical uncertainties create a volatile operating environment, dampening investment and disrupting global trade. Competition in high-tech sectors is also intensifying.
Now, let's summarize the strengths and insights and challenges and weaknesses across these factors. The core strength is the strategic pivot itself, recognizing the need for a more sustainable, quality-focused growth model.
This pivot allows for more targeted policy interventions, aiming to foster innovation and build resilience. It's a move towards a more mature economic phase, potentially leading to more stable employment and better social welfare in the long run.
The insight here is that China is actively trying to engineer a transition away from old growth drivers. They understand the limitations and are seeking to build new ones, even if it means slower headline growth.
However, the challenges are immense. The legacy issues like property debt and local government debt are significant drags that won't disappear overnight. Managing these while trying to foster new growth is a tightrope walk.
Demographic shifts are a powerful, long-term headwind that requires significant structural adaptation. Consumer confidence also remains a key variable that is difficult to control directly.
And the external environment is increasingly challenging. Geopolitical tensions and trade protectionism create uncertainty that can easily derail even the best-laid domestic plans.
So, to wrap up, the conclusion, a new chapter in China's economic story. This shift to a 4.5% to 5% GDP growth target is a fundamental recalibration, signaling a mature approach to development.
Beijing is consciously pivoting away from relentless, high-octane growth towards a more sustainable, quality-focused model. It's a pragmatic acknowledgement of domestic and international headwinds.
The persistent challenges, property sector, debt, demographics, cautious consumers, and geopolitical uncertainty necessitate this more deliberate pace. The targeted range reflects a delicate balancing act.
It suggests a strategic prioritization of structural reforms, innovation, and long-term resilience over sheer quantitative output. This transition is complex, like steering a supertanker.
For the global economy, this moderation means recalibrating demand, shifting supply chains, and re-evaluating investment strategies. The era of China as the sole engine of global growth is evolving.
Ultimately, this new growth target signifies China aiming not just to grow, but to grow well, focusing on domestic well-being, technological advancement, and sustainable development. It's a new, potentially more stable, chapter.
And that's a wrap on our deep dive into China's economic pivot. A fascinating shift to monitor closely.
Absolutely. Thanks for joining us on MbaguMedia Finance.